Hi and welcome to the special edition of HUBsights. I'm Anne McDonald, Head of Marketing at Hub24, and today we're really pleased to have with us Hamish Douglass, CEO, CIO and Lead Portfolio Manager at Magellan. Thanks for joining us, Hamish.
A pleasure, Anne.
We've seen some recent falls in tech stocks. Do you think it's time to get out?
Well, there's been very modest falls in tech stocks. Actually, the biggest falls has actually been in the big Chinese tech stocks. There's been a little bit drawback around Facebook around that, but its share price is still up very materially. So I think we have to be cautious thinking that we've seen a really big fall at this stage. But you're asking a more fundamental question. We are definitely late cycle in terms of the general market cycle. We've had a 9-year cycle. To say all prices are cheap in the markets, I think we need some caution around that. But if we get into tech stocks in particular, I think technology is a very, very wide term. It can capture a lot of things. There are tech stocks that have no fundamental earnings, that you question their valuations. Tesla would be a classic example where you may question a valuation of a tech stock like that. But if you look at some core technology holdings, for instance, that are very large when you hold, Apple, we've made a lot of money in Apple. It's doubled since we bought it, but it's now at 16 times earnings. Is 16 times earnings a bubble for Apple? We really don't think so. Do we know whether Apple's going to be higher or lower in the next 6 months? Frankly, we have no idea. That is unpredictable. But we're very confident over the next 5 years or so that you will make material amounts of money by remaining invested in Apple, even though its share price could be lower in six months or so. It's not like buying into a company with no earnings or buying into a company at 50 times earnings when you're paying 16 times earnings, which is actually less than the market is trading at. If I gave you an example of our largest investment at the moment that is at a slightly higher multiple is Alphabet, and Alphabet owns Google. So if we break Alphabet down and think about is it time to get out of Alphabet? Again, we've made a lot of money in Alphabet. Its earnings have gone up very substantially as well. Its largest business is an advertising business. I think we know its advertising search business. Its advertising business is still growing above 20% a year. Is its advertising business about to hit a brick wall? We don't think so. There are still some very large parts of the advertising market that Google has not yet penetrated. One of them is what we would call local-based advertising, sort of the old yellow and pink pages when you wanted to find the plumber or anything else. How did you actually find that? Google is now connecting local business to individuals. Once we have these smartphones in our pockets and you have any form of Google application or Google Maps or Google Search or something on that phone, it knows where you are. It also knows an enormous amount of information about you as an individual. Every search you've ever done on Google, it is kept. Unless you've had it deleted, it knows every question that you've asked Google. I guarantee you've probably asked Google a few questions over the last decade or so. It knows where you've been. If you've got Gmail, it knows what's been on your Gmail. If you've watched YouTube, it knows what you've watched on YouTube. If you've taken photographs and saved them to the Google Cloud, it knows information about the type of likes. You may have children and other things. It's quite scary in a way that they know that. But now they're trying to, via maps and geolocation, trying to connect businesses to individuals as they move around. That is a very, very valuable and untapped market. The other market in advertising that's untapped is television advertising. Television advertising, there's over $200 billion worth of advertising revenue outside of China that's on television. We would predict over the next 5 to 10 years that a huge amount of that advertising revenue that's on traditional forms of television, it could be pay television or broadcast television, that advertising is going to move to new forms of video. We're seeing a lot of video subscription, YouTube's, Netflix's, Amazon Prime. Advertising is going to shift to different business models, and we would argue that Google via YouTube is going to pick up a meaningful share of that 200 billion, and that tends to grow in line with global GDP growth. So we regard that core advertising business as still not mature and is going to grow substantially over the next decade. The question is, what do you pay for this? Is it time to get out? You pay 24 times this year's coming earnings for Google, but it's not as expensive as that. That doesn't seem that expensive. It doesn't seem a bubble. It's not 50 times earnings. But Google has $100 billion of cash, and they have two very large businesses that are currently losing money. that have enormous potential. One is called the Google Cloud Platform. The Google Cloud Platform is their infrastructure hosting business. So people are going to move their computers out of offices and host them in the cloud. There are three very large players in the world: Amazon Web Services, a business called Azure that is owned by Microsoft, and Google Cloud Platform. Google Cloud Platform being in the third place. Currently, there's about $60 billion worth of revenue that is shifted to people paying to have their applications hosted in the cloud and their software hosted in the cloud. We think it's a $600 to $700 billion market. And those companies are probably going to carve up most of it between them. Already the market's probably implying $300 to $400 billion of value on Amazon's business. It is very likely in the next 10 years that Google's, just its cloud hosting business, will be worth half its current market capitalisation. It's currently losing money. And they've got another business called Waymo. Waymo is their driverless car business. And we're getting very close to commercialisation at Waymo. At the end of this year, they're going to launch a autonomous robo-taxi service. So anyone in Phoenix, Arizona, will be able to call up on their Waymo app and a fully autonomous taxi at the end of this year. They're ordering 80,000 taxis. Those 80,000 taxis will be able to do about 8 million trips per day. And that is coming. This isn't the Jetsons in the future. This is coming, and then they can sell that technology. We think those two businesses are probably worth today at least $100 billion if they were separate companies. And they'll be worth a lot more in the future. They've got $100 billion of cash. So our very simple analysis, how much are we paying for that advertising business that I started with? Google is worth about $900 billion, third largest company in the world. Take off $100 billion of cash. Take off maybe $100 billion, which we think is a conservative estimate for Google Cloud and also Waymo, the driverless cars, $700 billion. The current earnings of the rest of the business, you're paying 18 or 19 times earnings for a core advertising business growing at more than 20% a year. Do we think it's time to get out of Alphabet? We think it would be crazy to get out of Alphabet today. We think you're going to make a material amount of money over the next 5 to 10 years from where it is priced today. That does not mean that Alphabet couldn't be lower in the next 3 to 6 months because of what's going on in markets and people getting nervous and that type of thing. We're not going to jump at whether people get nervous or things in the short term when we see a lot of potential over the 5 to 10 years, and we think it's fundamentally cheap compared to that, to what we can see in front of us. So that's an example. I've given you Apple, I've given you Alphabet. I'm not going to go through every company. There are technology companies that are truly overpriced. And I think the Chinese tech companies are being repriced because I think some of that got ahead of itself and people missed some of the business models to some of the things. I think they thought they were better than they're decent businesses, but I think they were ahead of themselves. So maybe they're correcting back into a bit more sensible territories than where they were at.